Hi there, it's producer Rob here. Now, maybe you're a new listener, maybe you've been listening for ages. Well, either way, if you're finding this podcast useful, then you might also like to subscribe to Which Money. You'll get our monthly magazine packed with tips on how to make the most of your cash, from growing your savings and investments to avoiding rip-offs and scams. You'll also be able to call our experts on the Which Money helpline as often as you like to get answers to your money queries. Just visit which.co.uk/join money. That's which.co.uk/join money and sign up today.
When life gives you questions, Which? Get answers.
Welcome to the Which Money podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
What I'm doing now is looking at my likely expenditure in the year ahead and working out how I can use things like digital savings pots to put a bit of money aside every month in order to build up to what I know is going to be a set fixed cost at certain parts of the year.
Think about how much you owe and what you can afford to repay each month. So say you've got that balance of £2,000 and you think you can afford to pay £100 off that each month. Then you'd be looking at a 0% deal, ideally lasting around 20 months.
Now, this week you might be feeling the pinch after spending big over the festive period, but thankfully there are plenty of ways to cut your costs and to boost the amount of cash in your wallet. And joining us to dive into ways to make and save money in 2025, as well as plenty of tips along the way, we have the Which Money editor, Jenny Ross.
Hello.
Hello, Jenny. And Claer Barrett, the consumer editor at the FT and presenter of the Money Clinic podcast. Welcome back, Claer.
Well, thanks for having me.
So good to have you both on the show today. It does seem like people are spending less over the Christmas period nowadays. I mean, is this something you've noticed, or would you say it's common for people to feel a bit stretched with cash at this time of year?
I think it's very varied. I mean, the cost of living crisis still lives on. We can see that in all manner of surveys. Things like the amount of energy debt that's built up, more than £3 billion now, the real struggles that different parts of the population are having. These are all examples of people in society who face mounting debts and chronic want in many cases. But then on the other side, of course, you've got evidence that consumers who do have cash to splash are splashing it with abandon. Winter sun holiday bookings, they haven't been as strong as this for many, many years. Although the retail sales figures that came out just before Christmas weren't as strong as expected, they were still up. And Black Friday has just become such a huge part of the pre-Christmas retail scene. So if you're somebody who's affected maybe by your mortgage payments going up, that could mean that you've got less money to spend. But then there are an awful lot of people who won't roll off a low rate onto higher mortgage rates until next year, or maybe even the year after. So it's very, very selective in who is really feeling the squeeze and who can afford to splurge a bit more. So a lot of variation.
Well, shall we just talk about debt for a moment? Because specifically, I'd like to just cover credit cards at the top of the show. I mean, Jenny, for anyone who might have used a credit card this Christmas or at all and might, they want to clear their debt, what are their options?
Yeah, the festive period is definitely the time of year where we're most likely to be turning to the plastic. So if you have built up, a sizable balance on your credit card and you are going to struggle to pay that off anytime soon, then it means you'll be racking up interest charges on that balance. But you don't have to be. The good news is that if you transfer that balance over to a 0% balance transfer card, you can avoid those interest charges altogether and basically buy yourself more time to pay off the debt that you've built up. So when you're comparing 0% balance transfer deals, really there are two key things that you need to pay attention to. One of them is the length of the deal. So, in other words, that is how long you're going to have to repay the debt that you've transferred before standard interest charges kick in. And at the moment, based on current deals, that's going to be anything up to 30 months. So that's more than 2 years. You've got to sort of spread out those payments. The second thing is that you've got to bear in mind that you'll generally be charged an upfront fee on a balance transfer card, which is a percentage of the amount that you're transferring. They can be around, anything up to about 3%, maybe a little bit more. So if you're transferring a balance of, say, £2,000, that's an upfront fee of 60 quid that you're going to have to factor in. One word of caution, I wouldn't just automatically plump for the longest balance transfer deal on the market. And that's because those longest cards generally charge the highest upfront fees. So if you think you can pay off what you owe in less time, so less than 30 months, for example, you could reduce that upfront fee, or even, there are still some cards on the market that don't charge a fee at all. So a handy sort of way of working out what deal is best for you is to think about how much you owe and what you can afford to repay each month. So say you've got that balance of £2,000 and you think you can afford to pay £100 off that each month, then you'd be looking at a 0% deal, ideally lasting around 20 months. A couple of final words of warning. Make sure you're paying off at least the minimum repayment every month. So obviously there's no rush because you've got that 0% deal to pay it off in full, but you do need to keep up with minimum repayments. Otherwise you could lose the deal and revert to the much higher sort of standard interest rate. And finally, obviously, this is a device to repay what you've already borrowed, not to keep borrowing. So be very wary about spending on a 0% balance transfer card unless it also has a 0% period on purchases, and that there are some of those out there. But as always with these things, you've got to check the T's and C's.
So much useful advice there. And Claire, is there anything that you'd add, generally speaking, advice for credit card users?
I'd go back a step and say, why do you need to borrow the money on credit cards in the first place? It's January, we've got the start of a new year. What I'm doing now is looking at my likely expenditure in the year ahead and working out how I can use things like digital savings pots to put a bit of money aside every month in order to build up to what I know is going to be a set fixed cost at certain parts of the year, whether that's a tax bill in January or July, whether it's the cost of Christmas in 2025, birthdays, holidays is the other classic one, because having to borrow at short notice to meet an emergency expense and then have to pay it off is one thing. But if you find that you've still got like last year's holiday, for example, on your credit card and you're still paying it off, that's the sort of borrowing that really is not affordable. And you need to look at and think, if I'm ever to get myself out of this situation, then I've got to change something about the spending. Just shifting your balance to another 0% card isn't going to do anything to affect that, sadly.
Changing habits. And now is a good time to think about those. And we'll get into savings in a moment. But first, as we're kind of on this theme, the start of the new year is as good a time as any to get your finances in order and earn a bit of extra cash. And the thing that comes up time and time again, I'm a huge fan of this, as our listeners will know, Jenny, it's switching your bank account. Can you just give us an introduction to how it works?
Yes, for any doubters out there, it is really as hassle-free as it possibly could be. It takes just 7 working days. And I think the thing that most people get a bit worried about is just what happens on the admin side. But the new bank will take care of all of the legwork of moving over your existing balance, transferring, your regular incoming and outgoing payments, and also, any payee details that you've saved, regular payments that you make, they will be moved over. Your old account closed down, and any payments that are made to your old account will be automatically redirected to your new one. So the hassle factor really shouldn't be a barrier. Instead, just focus on all of the benefits that can come from making a switch. So just looking at those upfront bonuses, at the moment you can make up to £175. So that's the sort of carrot to being dangled by First Direct at the moment, which also happens to be a Which recommended provider for current accounts. So you can expect some great customer service as well. Nationwide, similarly, that's got £175 switching bonus available at the moment. It also pays 5% on balances up to £1,500 in the first year on its Flex Direct account. So if you maintain that balance, that's an extra 75 quid after a year. So yeah, you really are quids in there. And then another one to mention, Santander, £100 £150 switching bonus, and it's on its Edge account. It pays 1% on certain spending categories, up to £20 a month. Although there is a £3 monthly fee that you need to factor in. So yes, we'll just say that, you know, basing your entire decision on who to bank with entirely on a short-term perk isn't really the best idea, but do consider those perks in the context of what else matters to you from your bank. So if you're overdrawn, does it offer a decent overdraft with relatively low fees? If you usually stay in credit, does it offer interest on those balances? But yeah, the process itself, I've done it several times. It's really pretty straightforward.
So have I. And I mean, it seems like a really easy win for me. Actually, literally last night, I was raving about switching to a couple of friends who have never done it before. Claire, what do you think? Is it a no-brainer for you?
I haven't actually switched bank for a couple of years because I can get perks of lower mortgage rates through my bank. They have got a deal on those. So, I mean, it's horses for courses, really, and that will save me an awful lot more over the years than £175 for a switching bonus. But it very much depends on the shape of your personal finances. Now, one area where it's even easier to switch, and it could save you even more money, several hundreds of pounds, is your mobile phone. And all you need to do to find out if you're out of contract on your mobile phone nowadays is send a text. You just have to text the word info, I-N-F-O, to the number 85075. It works like a charm. You'll immediately be told whether you're in contract or out of contract. And if you're still in contract, the date that your contract expires. So you can make a note of it. I'm a paper diary person. You might be an electronic reminder in your phone person. Either is fine. And if you want to keep your handset and then move to a SIM-only deal, that can really start to cut costs out of your monthly budget. There are lots of other things that you can do at this time of year. I'm a big advocate of going through all of the statements, bank statements, credit card statements, line by line, looking at direct debits, looking at recurring payments, the new modern curse, and seeing what can be cut out. And my final tip is have a good look in the settings, deep within the settings of your mobile phone, to see what apps you might be subscribed to, because all too often I'll get a notification, well, depending on who you're with, either from Apple or Android, saying money's been taken from your account because an annual app that you signed up for on a really low price has just renewed at a really high price. Now, I've challenged those a few times and I've got the money back within like 24 hours. But if you want to actually cancel an app, you can still use it until the period that you've paid for has run out. But then when it gets to the end, it won't automatically renew. So definitely go into the settings and have a look at those.
Okay, well, shall we bring in savings now then? Because we want you to be making the most possible from the savings that you have. And regular listeners will know by now that high street banks aren't the place to go if you want the best returns. So where should savers be looking instead?
The bigger picture with all of this is that we're expecting interest rates to fall in the year ahead. The Bank of England was expected to cut around 4 times in 2025. That's been pared back recently. We now only expect them to cut rates twice in the year ahead. But nevertheless, there's never been as many savings products on the market as there are now, according to one of the big compilers of savings deals. And there are quite a few that are a smidge under 5%, a couple of cash ISAs, money box. I've just moved some of my cash ISA pile in there, just under 5%. There are others too. There are lots of easy access deals, some quite sort of creative things going on. There's one of the providers is offering you a really high rate, like more than 4.5%, if you move your money there. So very good for like an emergency fund, and you get a higher interest rate if you leave the money alone. It's Atom Bank, again, one of the digital challenges. I think it's just over 4.5%. If you don't make any withdrawals, it stays at that amount. But if you do have to take some money out during the course of the next year, then the rate will gradually slip down. Regular savers, you've mentioned, obviously very high levels of interest, eye-catching, 7%. Lots of the banks are offering. Of course, once you've sort of worked it out, stepped out those amounts, over the course of a year, it's not going to be 7% on all of that money for the whole of the year. But if you're somebody who wants to just put aside a chunk of your wage check, pay yourself first, as they say, that may indeed be possible for you if you're one of many workers who's managed to get a pay rise this year. We can see from the ONS data that average pay has been rising faster than the rate of inflation for some time now, but also come the end of March, we're going to see that big jump up in the national minimum living wage for millions of workers. So perhaps a little opportunity there, especially if you're on universal credit, to explore a very underutilised savings product, in my view, which is the government scheme called Help to Save. Now, look up the details of this if you get universal credit or another benefit like that on the gov.uk website, but it effectively gives you 50p back for every £1 you're able to save over a period of about 2 years. Go and have a look at the details. Every time I mention this on a podcast or on the radio, I get a message on Instagram from somebody saying, I never knew about this, and I've opened up the account. But it really can be a lifeline if you're on a very low income but want to put a few pounds away and get the absolute maximum return.
I actually think it's the first time that's come up on the show as well. So amazing to hear about that. And Jenny, then, how do you decide which type of account is right for you? Because there are so many out there, as we've already touched on.
Yeah, generally, it really comes down to when you think you'll need to get your hands on that money. So if you're likely to need to access it at short notice, then an easy access account really is the way to go. There are no restrictions on when and how you can take the money out. The big drawback there is that rates are variable, so they can change at any time. And as Claire's mentioned, the trend is downwards at the moment. The best rates at the moment are just below 5%, talking 4.5, 4.75, around there. And if you compare that to the best 1 year fixed deal available at the moment, which is paying 4.8%, they're pretty much on a par. But obviously the benefit, if you can afford to lock your money away for that 12-month period, the benefit there is that that rate is not going anywhere. So whereas, you might take advantage of an easy access account paying 4.7%, let's say, in a couple of months that could drop much lower. So if you can afford to tie your money up for a little bit longer, given that rates are heading downwards at the moment, that seems like a shrewd move. Another thing just to bear in mind when you are looking, weighing up the type of account to go for is tax, because higher rates over the past few years mean that more savers are having to pay tax because they're earning enough interest to tip them over their personal savings allowance. So if you think that you are likely to need to pay tax, that you have enough money in savings, and we're talking, pretty significant sums really, probably about in the region of about 20k if you're a basic rate taxpayer, or 10k if you're a higher rate taxpayer, to tip you over your allowance, then don't forget that within an ISA, your money can grow completely free of tax, and you can save up to £20,000 every tax year in one.
Well, after a quick break now, we'll be back to talk about investing, as well as diving into tips on how to reduce some of your outgoings. We'll be back after this.
Saving for retirement can feel daunting. The same goes for managing your money once you've stopped working. That's why we've created an 8-week newsletter series breaking down what you need to consider, both pre and post-retirement, into bite-sized chunks. If you sign up to our free retirement newsletters, for 8 weeks we'll send you an email full of expert guidance to help you take control of your retirement planning and give you the confidence to make smart decisions. We'll help you get to grips with your pension, teach you how to boost your income, and explain more about care options. It doesn't matter when you sign up either. Your 8 weeks of advice will start whenever you sign up. So what are you waiting for? Head to which.co.uk/retirement newsletters, all one word, to get up to speed on everything you need to know for retirement.
Welcome back to the show. Well, let's get into investing now then. We specifically covered investment fees a month or so ago on the show, and we learned that those fees can quickly add up.
Yeah, so unlike savings, which we've just been talking about, as an investor, there are certain unavoidable costs that you're going to face. And that is because you'll be paying a fee for the individual investments that you hold, as well as most likely to the platform that you hold them with. So the best value platform for you really depends on several things. I mean, you need to think about the size of your portfolio and as well as what type of investor you are. Are you going to be doing a lot of buying and selling, in which case trading fees are something that you're going to need to pay attention to as well. So helpfully, investment platforms have lots of different charging models. It can all get quite confusing, but generally speaking, a platform that charges a percentage fee tends to work out better value for smaller portfolios compared to platforms that charge flat fixed fees over the course of the year, which generally speaking work out a little bit better if you have a larger portfolio. So that's what you need to consider when thinking about the platform to go for. In terms of the individual investments, the typical trend here is that if you opt for a passive fund, where basically the fund tracks a particular index and aims to mirror that performance of that particular index, you're generally going to be paying a lower fee than if you opt for an active fund, which is where you've got a fund manager actively picking investments with the hope of beating the performance of any given market. So you've really got to weigh up, if you do want one of those actively managed funds, is the performance really going to justify the slightly higher fee? But in both cases, fund fees can vary significantly. We're talking from as little as 0.001, up to 1%, much more. And obviously, those fees will apply regardless of how your investments perform. So you really need to pay attention to them and make sure you can justify them.
And Claire, can we hear some of your general advice for people wanting to invest, especially anyone listening, beginners out there looking to take the leap?
I would say, big lesson, it's not as complicated as you think, investing. Lots of chat already about fees and percentages, and I can feel myself thinking like, oh my god, this sounds so hard. It really isn't. The first rule of investing is make sure that you can lock your money away for at least 5 to 10 years. And if that's not you, with the amounts that you can afford to invest, then a savings account, building up an emergency pot of savings would be better, because the worst thing that can happen to you as an investor is that you risk your money in the market to get a better rate of return and beat inflation, unlike cash savings. But the market falls, you need the money for something else. Buying a new front door, for instance, which sadly I have to do in the next couple of months for an extortionate sum. And
Sorry to
you have to raise your pot. You're selling when markets are down, and you've made a loss. Now, nobody wants that. So you have to feel comfortable taking some risk. And the best way to feel comfortable about taking that risk is to take a long-term view, 5 to 10 years. So, for example, maybe you can only afford to invest £25 a month. That's fine. All of the major investment platforms start from that level. And obviously you can go up. I mean, if you wanted to do the full ISA, stocks and shares ISA allowance of £20,000 a year, that's an awful lot of money. But start small, £25. All of the investment platforms have got what they call quick start options, where you can choose a fund that's matched to your risk profile. You don't need to go around picking individual shares. You can choose a passive fund, as we've said. That's something that just tracks the market. You'll get the same return that the market's done. In recent years, passive funds have massively outperformed the more expensive active funds, where you're paying a manager to pick stocks for you. So lots of content to explore. We go through all of this in the financial course I've just done for the Financial Times, which is called Sort Your Financial Life Out. It's free if you're an FT subscriber, £19 if you're not, so quite cheap, because we've made this an entry-level product for people. But you get an email from me every 6 weeks, which takes you through every aspect of your finances, including investing, and you get free access So every single article I've ever written about this on ft.com, we point people in the direction of all of the content that I've done over the years for beginners, so you can feel much more informed about doing it when you do.
Well, just before we wrap up then, the final area I'd like to discuss is insurance. Something we can't avoid, but premiums have been rocketing in the past few years, haven't they? So, what can we do to pay as little as possible here, Jenny?
Yeah, it is a challenge that now, given what's happened in the past few years, for both car and home insurance. But I'd say it's particularly painful for drivers because, well, first of all, premiums are more expensive anyway. We're talking about an average of £612, according to the latest figures from the Association for British Insurers. That compares to £407 for home insurance. But there's also the fact that car insurance premiums hit a sort of record low. As a result of the pandemic, people were driving less, claims were lower, but obviously we're a long way from that now, and that is largely to do with the rising cost of paying claims for insurers. So things like repairs, supply chain issues, all of that has just translated into higher costs for us. The way around it, is to shop around, because it can still pay off despite the high prices now. In our latest survey, we found that 7 in 10 drivers renewing their car insurance who haggled, they did manage to secure a discount. Most commonly that was up to £40, but in some cases it was actually £100 plus. So hopefully that goes to show that there is still benefit in assessing the whole market before just automatically renewing, and using any better quotes you found elsewhere to negotiate a better deal with your existing insurer as well. So some other actions that can make a positive difference is to not leave your renewal too late. So generally speaking, if you're renewing a few weeks before the policy is due to expire rather than a few days, you'll get a better price. And also just to make sure you know exactly what you're buying. It sounds so obvious, but a lot of people just end up paying for more cover than they really need to. They maybe haven't sort of reassessed their needs the last few times that they've renewed, and there are certain parts of their cover that they could do without completely. Just as an example, if you've got cover for enhanced sort of courtesy car is included in your policy, but you already have access to another car. If for one reason one gets taken out of action, then you're just paying for something that you don't need. So yeah, fully check the policy documents, shop around, and hopefully those will make sure you're not paying way above what you need to.
And there's also the option of paying monthly or annually, and annually always wins, doesn't it?
It absolutely does in terms of the price you end up paying, because if you pay monthly, then in many cases you'll be paying pretty hefty interest charges to spread those payments. This is a real concern to us here at Which. It's effectively a tax on being poor. If you can't afford to pay the full premium for the year up front, then you are going to be punished, and we don't think that's right. And in fact, unfortunately, that's not the only problem within the insurance industry that is of concern to us right now, and that is why we have launched a campaign to really pressure insurers to treat their customers much more fairly. Unfortunately, on the claims side too, we've heard way too many horror stories in some cases of people whose claims have been so badly handled that it's seriously affected their quality of life. So change is needed, and we are putting pressure on to make sure that happens. So if you feel strongly about this, if you've had a bad experience with an insurer, then please do sign our petition and lend us your support. It's hugely appreciated. You'll be able to find the details in the show notes.
Yes, we'll get a link in the show notes. I just had a look, and we're at just over 90,000 signatures of a target of 100k. So do take a look.
Amazing.
Well, Jenny and Claire, it's been a fantastic show. Thank you both so much for joining. I hope our listeners have something to take away. I know I do. Lots of new things have cropped up today. So thank you very much.
Well, thanks so much for having me. It's always a pleasure to come on the Which podcast.
Well, a huge thank you again to Jenny and Claire for coming on the show today, and to you for listening to this week's episode of the Witch Money Podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Witch Money and online at witch.co.uk/money. And we also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit witch.co.uk/money newsletter. This episode of the Witch Money Podcast was presented by me, Lucia Ariano, and produced and edited by James Rowe.
If you're enjoying this podcast from us here at Witch, then why not become a Witch member? Right now, we've got a special offer, especially for podcast listeners, meaning you can choose any of our 3 membership tiers for 50% off the usual price. Starting at just £39.50 for a full year, you can get Witch magazine delivered direct to your door. For the same price, you could also choose a digital Witch subscription, giving you access to all of our product reviews, the Witch app, and the digital edition of Witch magazine. What's more, you'll also be able to use the Ask Witch service for personalised one-to-one buying advice. Or why not get a full access Witch subscription for just £49.50 for a full year? Don't forget, that's 50% off the usual price. To join Witch or to find out more, just head to witch.co.uk/podcast offer. That's witch.co.uk/podcast offer, or click the link in the description for today's podcast for 50% off a Witch annual subscription.